Hi, this is Marvin Stone. Welcome to TRID Update for today's mortgage lender. This webcast will be discussing title insurance and TRID.
Good afternoon. This is Dawn Llewellyn, Compliance Counsel and Senior Underwriter for Stewart Title Guarantee Company. This webcast is for informational purposes only. It should not be construed as legal, accounting, tax, or professional advice or services. You may not act in reliance upon this information without seeking professional advice. In all cases with regard to TRID compliance, we advise you to seek the advice of your own counsel and also to talk with your compliance department.
As your trusted partner in implementing the CFPB's new TRID closing process, Stewart is providing this webcast to ensure smooth closings for consumers during this time of tremendous change. Our partnership with our lenders is extremely important to Stewart. We do not want to see our lender partners in non-compliance, nor do we want to be in non-compliance because the liability is just too great. With more than 60 days of TRID implementation behind us, we've learned a lot and can now share the most up-to-date information on the sweeping changes brought about by the federal laws under TILA-RESPA integrated disclosures. Unlike the HUD-1, the loan estimate and closing disclosures are lender disclosure forms. TRID places these forms under Regulation Z Truth in Lending Act regulations. So they're TIL forms like your GFE and your initial final TIL were prior to TRID implementation. The loan estimate replaces the initial TIL and the GFE, and the closing disclosure replaces the final TIL and GFE. These are your disclosures to the borrower about the terms and costs of your loan.
So preparation of the CD, the closing disclosure, by the settlement agent or by the lender does carry with it some liability. The loan estimate and the closing disclosure are truth in lending disclosure forms. Under truth in lending, a borrower could sue as an individual lawsuit or in class action for violations of truth in lending and recover up to $4,000 or the lesser of $1 million in class action, plus actual damages and attorney's fees. Borrowers also have the right to rescind mortgages for errors in Regulation Z, such as information related to APR, finance charges, and payments. In contrast, borrowers could not sue for violations of the RESPA disclosure requirements. So liability is much broader under TRID than it was under RESPA. Also, we know that class action lawyers are watching TRID implementation carefully. Also, under the Dodd-Frank Welfare Reform Act, the CFPB has broad authority to impose civil money penalties up to $1 million per day for each violation of the rule. They also have remedies such as restitution to borrowers, refund of money, return of property, and limitations on mortgage lending activities and even disgorgement of all profits. And the penalties can be applied to individuals who violate federal consumer protection law as well. Even if a mortgage lender enters into servicing and indemnity agreements with service providers for the preparation of and delivery of the disclosures, the lender remains responsible. The CFPB is not bound by any contractual division of these liabilities. So the new TRID rule carries much greater liability and risk than the previous HUD disclosure. The CFPB has made it clear that borrowers' closing disclosure remains the responsibility of the lender, and the lender may be liable to CFPB for violations and to borrowers in class action lawsuits, regardless of who prepares and delivers the closing disclosure. Under the new rules, lenders are responsible for accuracy and timely delivering of the closing disclosure to the consumer. For this reason, nearly all lenders are planning to handle both the preparation and delivery of the closing disclosure. These lenders understand the liability of truth in lending, Dodd-Frank, is too great to allow settlement agents who have traditionally not prepared TILA disclosures to prepare the closing disclosure.
So be sure you have talked with your investors before asking the settlement agent to prepare and deliver the CD. Many investors will be conservative right out of the gate. We are hearing that investors will not buy loans with mistakes or that are not well documented under TRID. Any mistakes or violations, they will not buy these loans. Fannie Mae, Freddie Mac, and other major lenders are adhering to strict interpretation of the TRID regulations to ensure that they have solid loans. Lender control over the closing disclosure also helps to protect all involved. That is why major national lenders such as Wells Fargo, Bank of America, and others have, and virtually really all national lenders, have insisted on preparing and delivering the closing disclosure to the consumer.
So some mortgage lenders have asked the question about delivery of the closing disclosure to the consumer, and what does the 3 business day delivery really mean under the rule? Alta has a really good timeline for counting the 3 business day rule requirement for CD delivery. Lenders need to understand the importance of the rule's distinction between providing, delivery, and receiving the closing disclosure. The consumer must receive the closing disclosure 3 business days before consummation. Consummation being the date that a consumer becomes contractually obligated on the loan under state law. Most lenders are considering this to be the date the consumer signs the note. If the lender does not provide the CD to the consumer or consumers in person, then there's a presumption that it takes 3 days for delivery to the consumer, and then the consumer is considered to have received it 3 days from that. So if the lender puts the CD in the mail on a Monday, delivery is presumed on Thursday, then you count the 3 business day waiting period, and the earliest you can close would be the preceding Monday. Sundays do not count, nor do all U.S. postal holidays in counting the 3-day rule. Remember that the lender is responsible for everything, even if the lender allows the settlement agent to prepare and deliver the closing disclosure to the consumer. There's no way to avoid responsibility, as the CFPB is not bound by any contractual division of responsibility. Under the rule, if the disclosure becomes inaccurate before consummation, the creditor must provide corrected disclosures reflecting any changes in the fees to the consumer. Therefore, all items related to the transaction must be disclosed on the closing disclosure. Borrowers must know before they owe. Borrowers must understand the mortgage transaction, the consumer's costs that are required by the lender in order for the lender to provide the loan to the consumer to ensure that the consumer is not surprised at the closing. Remember, the intent of the rule is to help the consumer understand the mortgage transaction and the consumer's costs associated with the loan, even if these costs are not paid from closing funds, even if someone other than the consumer is paying these costs, or the fees and costs relate to closing, settlement, and title insurance. The simultaneous rate for title insurance under the rule is another part of the rule that's very confusing for everyone in the industry. Under the rule, TRID requires a simultaneous rate to be disclosed on both the loan estimate and the closing disclosure in accordance with the rule. This means that the full loan policy must be disclosed to the consumer on the new closing disclosure and loan estimate. The TRID owner's policy formula must be disclosed as the sum of the full owner's policy plus the loan simultaneous premium minus the full loan policy premium. This TRID OTP formula must be shown on both the loan estimate and on the closing disclosure. And this slide shows you the section of the rule that says that the same formula must be used on the closing disclosure that is used on the loan estimate for the simultaneous rate.
When both a loan and owner's title insurance policy will be purchased in a transaction called simultaneous issuance, the TRID requires the lender or settlement agent to inaccurately disclose the title premiums on the closing disclosure when the seller pays a portion of the title insurance. Cash to close will not accurately show the correct total title insurance cost that each party should pay. So what to do? The Bureau has provided 3 methods to disclose the seller's credit for a seller-paid owner's policy of title insurance under the final rule. There will be more detail provided on these 3 methods in the special features section following the conclusion of this presentation. So, the takeaways. Change ahead. This is not considered to be an incremental improvement. TRID is a major overhaul in the industry. Watch for TRID trends. Be flexible in your approach and be ready to adapt and embrace change. Remember, the CFPB's Know Before You Owe website has many TRID implementation resources. As always, Stewart wishes to be your trusted partner during this time of great change. Please reach out to your Stewart closing professional with any questions or concerns you may have. For those of you who may be interested in learning more about the seller-paid title insurance and details on the CFPB's 3 methods of showing simultaneous issuance on the closing disclosure, please stay tuned for additional information. Dawn?
Thank you. So we're going to take a few minutes to go through a few examples to demonstrate the 3 methods to disclose the seller credit for an owner's policy under the final rule approved by the CFPB. These are all instances where the seller pays a portion of the title insurance premium in a simultaneous transaction. Under option 1, the remaining seller credit can be applied towards any other title insurance related costs, including the lender's title insurance premium. In example 1, the full owner's policy is $1,274. The seller pays 100% of the owner's title insurance premium. The simultaneous rate for the loan policy is $517, and the full loan policy is $1,017. So we use the TRID formula to calculate the owner's title insurance. That is actually $774, which is the sum of the full owner's policy plus the simultaneous rate for the loan policy minus the full loan policy. This will be shown in the seller paid column in H, or other. The title premium adjustment is $500. This is the difference between the simultaneous rate loan policy and the full loan policy amount. This will be shown in the seller paid column on the lender's title insurance line. The title premium adjustment plus the TRID OTP is the seller paid owner's policy in cash to close. The borrower balance paid after you subtract the seller paid amount is shown in the buyer paid column, and the buyer paid loan policy balance is shown in cash to close. So here you see that you have the borrower balance after seller paid amount of $517 in the buyer paid column. You have the $500, which is the balance of the seller paid amount after the TRID OTP in the seller paid column, and then you have the TRID OTP formula of $774 in the seller paid column, and at the very bottom you see your cash to close balances. In option 2, the remaining seller credit can be considered a general seller credit and disclosed as such in the summaries of transactions table on page 3. On page 2 of the CD, you see the full owner's policy is $1,274. Here the seller pays 100% of the owner's title insurance premium. The simultaneous rate is $517. The full loan policy is $1,017. This full loan policy will be shown in the buyer paid column in the loan policy line here, as you see, the $1,117. Then you use the TRID calculated OTP, and you show that in the seller paid column. That is the sum of the full owner's policy plus the simultaneous rate minus the full loan policy for a sum of $774. This is going to be shown again in the seller paid column in section H. Then you go over to page 3 of the CD, and you'll show a title premium adjustment of $500. This is the difference between the simultaneous rate loan policy and the full loan policy amount. This amount will be shown as a general seller credit for title insurance of $500. It appears to be a debit to the seller and a credit to the buyer, as you see here on page 3 under the adjustments. The third option given by the Bureau is the remaining seller credit can be shown as a title premium adjustment. This is the difference between the actual cost of the owner's title insurance and the disclosed amount, again in the summaries of transaction on page 3 of the closing disclosure. So here we're going to be using the same numbers. The full owner's policy is $1,274. Seller pays 100% of the owner's title insurance premium. You have your simultaneous loan policy rate of $517, and you have your full loan policy rate of $1,017. Your TRID calculated owner's policy is $774. So you show the full owner's policy in the buyer paid column of $1,017 by the lender's policy of title insurance. Then you show the TRID formula in the seller paid column for the owner's title insurance in section H, other. Then on page 3 of the CD, you show a title premium adjustment of $500 in both the buyer paid column and the seller paid column. That title premium adjustment here is $500. It is the difference between the simultaneous rate loan policy and the full loan policy amount. This appears as a debit to the seller and a credit to the buyer. Another example of this, here you have a full owner's policy of $350, a simultaneous rate of loan policy for the loan policy is $500, and a full loan policy rate of $1,500. So in this example, you show the $1,500 in the loan policy using the TRID formula, you actually have a negative number here. So you have a negative $700. That is the sum of the TRID formula using the full owner's policy of $350, adding the $500 simultaneous rate, and subtracting out the full loan policy. So in this case, the TRID OTP is a negative number, and yes, it is true, and yes, it can happen in some states where you have a discount on the owner's policy. You will see a negative number here, and that is what the rule requires. In this example, you will again show a title premium adjustment on page 3, and it is important that you calculate the full owner's policy by applying all discounts up front and then calculate the TRID formula. And in some cases, as in this example, you will have a negative number, but again, cash to close will be balanced on page 3 using the title premium adjustment.
Great, thank you, Dawn.